Small Steps, Big Gains. Unlocking Financial Freedom with Compounding. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. What if I told you that the key to financial freedom isn't found in high-stakes investments, insider tips, or earning a massive paycheck? What if, instead, the real secret to building lasting wealth lies in taking small, consistent steps over time, steps so small you might not notice the results right away, but given time, would lead to life-changing financial gains? Maybe you've heard of compounding before, but you're not quite sure how it works. Or maybe you've always thought that building wealth requires big risks, quick wins, or access to financial markets that feel out of reach. Here's the good news: you don't need any of that to start growing your money today. The truth is, you can start small and still achieve big results. This book will show you how. At its core, compounding is about growth on top of growth. Imagine planting a tree from a tiny seed. At first, the seed barely sprouts. It's easy to get impatient because you don't see any major changes right away. But as you water it consistently and give it time, that seed grows roots, breaks through the soil, and eventually it becomes a towering tree. Over time, the growth becomes exponential. Compounding works the same way. When you invest or save, the returns you earn from your money start generating their own returns. Over time, those returns grow on top of each other, like layers, leading to wealth that increases at an accelerating rate. It's not magic, but it feels like it. The real secret? Time and consistency. That's why the earlier you start, the more time you give compounding to work. Even small steps, when taken consistently, lead to big gains. Who is this book for? This book is for anyone who has ever felt overwhelmed by their financial goals. It's for the person who's been told that investing is only for the wealthy, or that achieving financial freedom requires insider knowledge and high-risk ventures. It's for people who want to grow their money but don't know where to begin, or for those who feel like they're starting too late to make a difference. It's also for seasoned investors who want to revisit the basics and understand how small, calculated moves can lead to major financial growth. If you've ever wondered how some people seem to accumulate wealth steadily and effortlessly, while others struggle despite making big moves, this book will show you why small, strategic steps win the race. The sooner you start applying these principles, the sooner you'll see the benefits. Whether you're 20, 40, or 60, it's never too late to start, but the earlier you begin, the greater the impact. If you've ever felt overwhelmed by financial planning or thought that building wealth was out of your reach, this book is for you. I'm here to show you that financial freedom is not only possible, it's achievable through small steps that lead to big gains. We've noticed that 67% of you watching our videos haven't subscribed to the channel yet. Help us grow by hitting the subscribe button and giving this video a thumbs up. Thank you for inspiring us to keep creating content for you. I would love to hear your thoughts. How did this book resonate with you? And what insights or questions did it inspire? Let's get started. Chapter 1. Why compounding is the key to building wealth. Imagine planting a small seed in the ground. Every day you water it, give it sunlight, and watch as slowly but surely it starts to grow. Before long, that tiny seed has become a towering tree, its roots deep, its branches wide. This is how the power of compounding works. It takes something small, and over time, grows it into something remarkable. Compounding is more than just a mathematical principle, it's the cornerstone of wealth building. Many people believe that in order to become wealthy, you need a high income or the ability to pick perfect stocks. But the truth is, what matters most is time, patience, and the smart use of compounding. The earlier you start, the more powerful the effects, and the less you need to do later. Compounding is, quite literally, making your money work for you. What is compounding? At its most basic level, compounding occurs when the money you earn on an investment starts earning its own returns. It's the process of earning interest on interest. Let's break it down. Say you invest $100 at an annual interest rate of 5%. After 1 year, you'll have $105, your original $100, plus $5 in interest. Now, in the second year, instead of earning interest on just $100, you earn it on $105. So you'll get $5.25, bringing your total to $110.25. Over time, this growth accelerates. The key to compounding is time. The longer your money stays invested, the more your initial investment and the interest it earns will grow. Even small amounts given enough time can result in significant gains. The magic of compounding lies in how it grows exponentially, not linearly. Take a moment to think about where your money is currently sitting. Are you letting it grow, or is it stagnant? Write down one action you can take today to start putting your money to work. Here's where many people go wrong. They think that becoming wealthy requires a high-paying job or some secret stock-picking strategy. But wealth building isn't about how much you earn, it's about how you manage the money you already have. The biggest mindset shift you can make is to start thinking of your money as a worker. Each dollar you invest isn't just sitting there, it's actively working for you, generating more money. When you reframe your relationship with money in this way, you begin to understand the real potential of compounding. You don't need a windfall to start building wealth, you just need time and consistency. Let's consider the story of Sarah. At 25, Sarah decided to start investing just $50 a month into a simple index fund. It didn't seem like much at first, but by the time she reached 55, that small amount had grown to over $100,000, thanks to the power of compounding. The key wasn't a high salary, it was Sarah's commitment to letting her money grow over time. You can do this too. The sooner you start, the more time your money has to grow. And the best part, you don't need to be a financial expert to get started. Compounding does the hard work for you. Take a moment to consider how much time you're allowing your money to grow. Are you thinking in the short term or long term? How can you shift your mindset to focus on growing wealth, not just earning money? How long does it take to double your money? One of the most exciting things about compounding is how quickly it can double your money, given the right conditions. The rule of 72 is a simple formula to estimate how long it will take for an investment to double in value, based on its annual return rate. The formula is 72 divided by interest rate equals years to double your money. For example, if you're earning 6% on an investment, it will take approximately 12 years for your money to double. 72 divided by 6 equals 12. If your investment is earning 8%, it will only take 9 years to double. This simple rule helps you visualize the power of compounding and gives you a tangible goal to work towards. Understanding the rule of 72 shows that even modest returns can yield big rewards over time. Calculate how long it will take for your current investments to double. Are you satisfied with the rate of growth, or can you make changes to optimize your returns? Getting started, it's easier than you think. The best part about compounding is that you don't need a large amount of money to start. Small, consistent investments can lead to significant growth over time. Whether it's $10 a week or $100 a month, the key is to begin now. Start by setting up automatic contributions to an investment or savings account. Automation ensures that you're consistently investing without having to think about it. This way, compounding can start working its magic, and you can focus on other aspects of your life. Compounding is the key to financial freedom. By shifting your mindset and taking small, consistent actions, you'll start building wealth that works for you. Don't wait to start. Time is your most valuable asset. Chapter 2. Time is your biggest asset, starting now. When it comes to compounding, time is the most critical factor. It's the difference between your money working at a slow, steady pace or growing exponentially. The sooner you start, the more time your money has to grow, and the less you'll need to contribute later. This chapter will show you just how powerful time can be, and why starting today, no matter how small, is the key to unlocking the true potential of your financial future. Why starting early matters. Let's look at a simple comparison. Imagine two people, John and Jane. John starts saving and investing at age 25, contributing $200 a month to a retirement account, earning an average return of 7% annually. Jane, on the other hand, waits until she's 35 to start investing, but she contributes $300 a month, thinking she'll catch up quickly. By the time John reaches 65, his investments have grown to over $500,000, while Jane, despite contributing more each month, only reaches about $400,000. The reason? John's head start gave his investments an extra 10 years to compound. The power of compounding isn't just about how much you contribute, it's about giving your money time to grow. This example highlights a simple truth: the earlier you start, the more your money can grow, even if you invest smaller amounts. Compounding rewards those who start early. If you haven't started yet, don't wait. Even if you can only contribute a small amount each month, start now. The key is to give your money as much time as possible to compound. Write down one action you'll take today to open or contribute to a savings or investment account. Procrastination is the enemy of compounding. Every year you wait to start investing is a year of lost potential growth. Let's take a look at what happens when you delay investing for just 10 years. If you were to invest $5,000 annually starting today with an average return of 7%, in 30 years, you'd have over $500,000. But if you waited just 10 years to start investing, you'd only have about $245,000 at the end of the same period. By waiting, you lose out on hundreds of thousands of dollars, all because of the time you can't get back. The longer you wait, the harder it is to catch up, and the more money you'll need to contribute to reach the same goal. But here's the good news: if you're reading this and haven't started yet, there's still time. You may not have started as early as John in the previous example, but what matters now is that you begin. Even if it's small steps, you're setting yourself up for a brighter financial future. The best time to plant a tree was 20 years ago. The second best time is today. What has held you back from investing or saving for the future? Write down one mindset or habit you need to change to prioritize your financial future. The magic of long-term thinking. Many people focus on short-term gains, wanting immediate results from their investments. But compounding is a long-term game. It's about patience and letting time do its work. The key is to resist the urge to withdraw your money too soon or chase quick returns. Think of it this way: compounding is like growing a tree, not a flower. A flower might bloom quickly, but it withers just as fast. A tree, on the other hand, takes years to grow, but once it matures, it provides shade, fruit, and strong roots for decades. Similarly, your money needs time to grow into something sustainable and lasting. If you stay the course and resist the temptation to make rash decisions, you'll be rewarded in the long run. In fact, the biggest gains often come in the later stages of compounding, when the exponential growth really starts to kick in. Commit to thinking long-term. Write down a 5 or 10-year goal for your investments. Imagine how much your money could grow in that time. What steps can you take today to move closer to that goal? Start small, think big. One of the biggest misconceptions about investing is that you need a lot of money to get started. But the truth is, compounding works just as well with small amounts. What matters most is starting early and being consistent. Even if you only have a small amount to invest, the earlier you start, the better. Let's say you can only afford to invest $50 a month. While it might not seem like much, over 30 years that $50 could grow to more than $50,000 at an average annual return of 7%. Small actions, when repeated consistently over time, can lead to big results. Compounding isn't about making a huge initial investment, it's about letting your money grow over time. What's the smallest amount you can start investing right now? Don't worry about starting big, focus on being consistent. Write down a plan to automate a small monthly investment. Patience is one of the most important, and often overlooked, factors in financial success. It's easy to get discouraged when you don't see immediate results, but compounding requires a long-term commitment. The biggest gains come from letting your investments sit and grow over time. One of the greatest investors of all time, Warren Buffett, is a strong believer in the power of compounding. He famously said, "The stock market is designed to transfer money from the active to the patient." By staying patient and letting time work in your favor, you're positioning yourself for financial success. Remember, compounding rewards those who wait. The longer you let your money grow, the more powerful the results. Time is your biggest ally when it comes to building wealth. Start now, even if it's small, and let compounding work for you. Patience and consistency will lead to financial freedom. Chapter 3. Small steps, big gains. Why consistency matters. In the journey of building wealth through compounding, consistency is the engine that drives your progress. Time is important, but without regular, ongoing contributions, your money won't have the fuel it needs to grow exponentially. The secret to turning small actions into large financial gains lies in staying consistent. This chapter will show you how even small, routine investments can lead to significant wealth over time, and how you can make consistency a habit in your financial life. The power of small, consistent contributions. One of the biggest misconceptions about investing is that you need large amounts of money to make a difference. In reality, the power of compounding works just as well with small, regular contributions as it does with larger ones. The key is consistency over time. Imagine you invest just $100 a month into a retirement account that grows at an average rate of 7% annually. At first, it might seem like you're barely making a dent. But after 10 years, that $100 a month will have grown to over $17,000. After 20 years, it will be over $52,000. And after 30 years, it will grow to over $122,000. What started as a small, monthly habit has turned into a sizable chunk of wealth, without any major financial sacrifice. The beauty of compounding is that it rewards those who stick with it. The longer you stay consistent, the bigger the gains. Small steps taken regularly lead to big results. Commit to a small, regular contribution. It doesn't matter if it's $50 or $500, what matters is that you make it a habit. Write down an amount you can consistently invest each month, and set up an automatic transfer to your investment or savings account. Focus on progress, not timing. One of the biggest mistakes people make when investing is waiting for the perfect time to start. They worry about market fluctuations, timing their investments, or waiting until they have more money to invest. But compounding isn't about perfection, it's about progress. The truth is, you'll never be able to perfectly time the market. But you don't need to. By investing consistently regardless of market conditions, you'll benefit from dollar cost averaging, which means you'll buy more shares when prices are low and fewer shares when prices are high. Over time, this smooths out the market's ups and downs and helps reduce the impact of volatility. Instead of waiting for the perfect moment, focus on building a habit of regular investing. Consistency beats perfection every time. Have you been waiting for the right time to start investing or saving? How has this affected your financial progress? Write down one mindset shift you can make to focus on consistency instead of perfection. How automation makes consistency easy. Building wealth is a long-term game, and consistency can be hard to maintain over time, especially when life gets busy. That's where automation comes in. By automating your savings and investment contributions, you take the pressure off yourself and ensure that your money is working for you, even when you're not thinking about it. Automation is a powerful tool because it removes the temptation to skip a month or use your money for something else. Once your contributions are automated, the habit is set in motion, and you're on autopilot toward your financial goals. Think of it like setting up a subscription to your financial future. Just like you might pay for a streaming service or gym membership each month, automated contributions become a regular part of your life. And over time, you'll see the rewards. Set up an automatic transfer from your checking account to your investment account. Whether it's weekly, bi-weekly, or monthly, make sure your contributions happen consistently, without needing to think about it. Write down the date and amount of your automated transfers. One of the hardest parts of staying consistent is dealing with the emotional roller coaster of the stock market. When markets go up, it's easy to stay motivated and keep investing. But when markets take a dive, fear and uncertainty can creep in, making you want to pull out your money or stop contributing altogether. But here's the truth: market fluctuations are a natural part of investing. In fact, downturns are a normal and necessary part of the market's long-term growth. Historically, the stock market has always recovered from downturns and continued to grow over time. The key to benefiting from compounding is staying consistent, especially during market dips. By continuing to invest when prices are low, you're buying more shares at a discount, which sets you up for greater gains when the market rebounds. The worst thing you can do during a market downturn is panic and pull your money out. Instead, stay the course, trust in the power of compounding, and remember that long-term consistency beats short-term reactions. Think about a time when fear or uncertainty caused you to stop investing or saving. How did that impact your progress? Write down one strategy you can use to stay consistent during market fluctuations, such as automating your contributions or reminding yourself of your long-term goals. Long-term commitment, the power of staying the course. The real secret to building wealth through compounding isn't about making huge, one-time investments. It's about staying the course for the long term. Wealth building is a marathon, not a sprint, and the biggest rewards come to those who are patient and consistent over time. It's easy to get discouraged in the early years when the gains seem small, but remember, compounding works exponentially. The longer you stay invested, the faster your money grows. The most significant gains often come in the later years of compounding, when the growth becomes more dramatic. By staying consistent and committed, you're positioning yourself for long-term success. Think of consistency as your greatest financial asset. It may not be flashy, but it's powerful. The more you stick with your plan, the bigger the rewards. Small steps, taken consistently over time, lead to big gains. Whether it's $50 or $500 a month, the key is to stay consistent, automate your contributions, and trust in the power of compounding. Over time, you'll see how those small steps add up to significant wealth. Chapter 4. The Rule of 72, Doubling Your Money with Ease. Now that you've learned the power of starting early and staying consistent, it's time to introduce a simple yet powerful tool to help you measure the growth of your investments, the Rule of 72. This handy formula allows you to quickly calculate how long it will take for your money to double based on a given rate of return. In this chapter, we'll explore how to use the Rule of 72, its practical applications, and why understanding this rule can help guide your financial decisions and set realistic goals. What is the Rule of 72? The Rule of 72 is a simple way to estimate how long it will take for an investment to double in value at a given interest or growth rate. The formula is straightforward. 72 divided by interest rate equals years to double your money. For example, if your investment earns an annual return of 6%, divide 72 by 6, and you'll see that it will take 12 years for your money to double. If you're earning 8%, it will take 9 years. This quick calculation can help you understand the power of compounding and give you a clear sense of how long it will take to reach your financial goals. The Rule of 72 simplifies complex financial math and helps you visualize the benefits of staying invested over time. Take a moment to calculate how long it will take your current investments to double. Use the Rule of 72 with different interest rates to see how varying returns impact your long-term wealth growth. While the idea of doubling your money is exciting, what's truly remarkable is how compounding accelerates as your money continues to grow. The first time your investment doubles is just the beginning. The longer you stay invested, the more exponential the growth becomes. Let's break it down. If you invest $10,000 at an average return of 7%, according to the Rule of 72, it will take roughly 10 years for that $10,000 to grow into $20,000. But what happens after that? If you leave the $20,000 invested for another 10 years at the same return, it will double again to $40,000. And after another 10 years, it will double once more to $80,000. Each time your money doubles, it grows exponentially larger, thanks to the power of compounding. The key takeaway is that the longer you leave your money invested, the more dramatic the growth. It's not just about doubling your money once, it's about doubling it multiple times over your lifetime. How long are you willing to let your money stay invested? Write down your financial goals and consider how the Rule of 72 can help you set realistic expectations for doubling your investments over time. Using the Rule of 72 to set realistic financial goals. The Rule of 72 can also help you set more realistic financial goals by allowing you to estimate how long it will take to reach specific milestones based on your current investments. For example, if you're hoping to grow your portfolio from $50,000 to $100,000, and you're earning 6% annually, you know that it will take approximately 12 years for your money to double. You can use the Rule of 72 to estimate the timeline for financial milestones: doubling your savings, reaching a certain amount for retirement. Evaluate different investment options based on their projected returns. Adjust your strategy if you need to reach a goal more quickly by increasing contributions or seeking investments with higher returns, though keep in mind, higher returns often come with higher risk. It's important to remember that the Rule of 72 is a rough estimate. Real-life returns vary from year to year, and factors like inflation and fees can impact the actual growth of your investments. However, this rule provides a simple, easy-to-use benchmark to guide your financial planning. Set a specific financial goal, such as doubling your savings or reaching a target retirement amount. Use the Rule of 72 to estimate how long it will take to achieve that goal with your current investments, and consider whether you need to adjust your strategy to meet your timeline. While the Rule of 72 is an excellent tool for understanding the potential of your investments, it's crucial to remember that higher returns often come with higher risks. When you're seeking to double your money more quickly, you might be tempted to chase investments with higher returns, but this can lead to increased volatility and potential losses. For example, if you invest in stocks, you might see an average annual return of 8 to 10%, meaning your money could double in about 7 to 9 years. However, stocks are also subject to market downturns, and you could experience years where your investment loses value. On the other hand, safer investments like bonds or savings accounts offer lower returns, typically 2 to 4%, but they come with less risk. The key is to balance your portfolio based on your risk tolerance and long-term goals. It's important to stay diversified, keeping some investments in higher growth assets and others in safer, lower growth options. Compounding works best when you leave your money in the market over the long term, so the most important thing is to stay invested, even through market ups and downs. Consider your risk tolerance and how comfortable you are with market fluctuations. Are you willing to accept more volatility for potentially higher returns, or would you prefer a more stable, slower growth? Write down how you feel about risk and how that aligns with your long-term financial goals. Doubling your money isn't the end, it's the beginning. It's easy to get fixated on the idea of doubling your money, but remember, this is just the beginning. Compounding continues to work its magic as long as you stay invested. Each time your money doubles, the next doubling comes faster and grows larger. The beauty of compounding is that it's not a one-time event, it's a continuous process of growth. Your job is to stay patient, stay invested, and stay consistent. As your investments grow, resist the temptation to withdraw early or make emotional decisions based on short-term market movements. Compounding rewards those who think long-term and stay committed to their financial plan. The Rule of 72 is a powerful tool for understanding how quickly your money can grow, but it's just a starting point. The real power of compounding comes from staying consistent, balancing risk with return, and letting time do the hard work of doubling your money over and over again. Chapter 5. Choosing investments that compound over time. Now that you understand the power of compounding and how it can double your money, the next step is selecting the right investments to harness this potential. Not all assets compound at the same rate or in the same way. In this chapter, we'll explore different types of investments, such as stocks, bonds, real estate, and other vehicles that can help you build wealth through compounding. You'll learn how to choose the right balance of risk and return to meet your financial goals. Understanding different types of investments. Compounding works differently across various asset classes. Some investments offer higher potential returns, but also come with more risk. Others provide steady, reliable growth, but at a slower pace. Let's break down the most common types of investments and how they compound over time. Stocks are shares of ownership in a company. Over the long term, the stock market has historically provided average returns of 7 to 10% per year, making it a powerful vehicle for compounding. However, stock prices can fluctuate in the short term, which means you'll experience more volatility along the way. Bonds are loans you give to a company or government, which pay you interest over time. Bonds generally offer lower returns than stocks, typically between 2 to 6%, but they're also less risky. Bond investments compound more slowly, but they can provide stability in a portfolio. Real estate investments can grow in value through both appreciation when the property increases in price and rental income. Real estate can be a strong investment for compounding, especially if you reinvest rental income into more properties or other assets. Savings accounts, certificates of deposit. While these are considered the safest investments, they also offer the lowest returns, often in the range of 0.5% to 2% per year. They compound slowly and are typically best for short-term goals or emergency savings. Mutual funds, index funds. These are collections of stocks or bonds grouped together in one fund, offering diversification and reducing individual risk. Many people choose index funds, which track a market index like the S&P 500. Index funds are a powerful tool for compounding because they spread out risk while providing long-term growth potential similar to stocks. Write down which types of investments you currently have, if any. Are they mostly stocks, bonds, real estate, or something else? If you're not invested yet, research one type of investment that interests you and write down how it could fit into your financial plan. Balancing risk and return. When choosing investments that will compound over time, it's important to balance risk and return. The general rule is, the higher the potential return, the higher the risk. Stocks, for example, can offer higher returns, but can also lose value in the short term. Bonds and savings accounts offer more stability, but grow your money more slowly. The key to building wealth through compounding is diversification, spreading your investments across different asset classes to balance risk while still aiming for growth. If one investment underperforms, the others can help cushion the loss. By diversifying, you allow compounding to work across multiple investments at the same time, which can smooth out the bumps of market volatility and keep you on track toward your financial goals. Imagine your portfolio as a garden. You wouldn't want to plant only one type of seed because if something happens to that crop, your entire garden suffers. But by planting a variety of seeds, some that grow quickly, others that are more resilient, you increase your chances of a bountiful harvest. Think about your comfort level with risk. Are you more comfortable with steady, predictable returns, or are you willing to tolerate more ups and downs for the chance of higher growth? Write down how you feel about risk and whether you need to diversify your investments further. One often overlooked factor in compounding is dividend reinvestment. Dividends are payments made by companies to their shareholders, usually as a portion of profits. Some companies, especially large, well-established ones, pay regular dividends to shareholders. Instead of taking the dividends as cash, you can choose to reinvest them, buying more shares of stock, which leads to more compounding. For example, let's say you own 100 shares of a company that pays a dividend of $1 per share. At the end of the year, you receive $100 in dividends. If you reinvest that $100 into more shares, you'll own more stock, and next year, your dividend payment will be even larger because it's based on a higher number of shares. Over time, this reinvestment can significantly boost your overall returns. The key to maximizing compounding is to reinvest any income your investments generate, whether it's dividends from stocks, interest from bonds, or rental income from real estate. By reinvesting, you allow your money to compound more rapidly. If you own dividend-paying stocks or mutual funds, check whether you're reinvesting your dividends. If you're not, consider switching to automatic reinvestment to boost your compounding potential. Real estate is another powerful tool for compounding wealth. While it doesn't work exactly like stocks or bonds, real estate investments can grow through appreciation and rental income. If you buy a property and its value increases over time, that's appreciation at work. But what makes real estate especially powerful is the ability to generate income through rent, which can be reinvested into other properties or investments, adding to your compounding strategy. For example, let's say you buy a rental property that earns you $1,000 a month in net rental income. You could take that money and spend it, but if you reinvest it, whether into another property or into stocks, you'll accelerate your wealth building. This is how real estate can become a compounding machine, as you generate both asset growth and income that can be reinvested. Of course, real estate comes with its own risks, such as market fluctuations, maintenance costs, and potential vacancies. It's important to approach real estate with a long-term mindset and ensure that it fits into your overall investment strategy. Consider whether real estate fits into your financial plan. If you're already investing in real estate, think about how you can reinvest your rental income to accelerate your wealth building. If you're not invested in real estate yet, research one potential opportunity to diversify your portfolio. Maximizing compounding with tax-advantaged accounts. Tax-advantaged accounts, like 401ks and IRAs, can play a significant role in compounding because they allow your investments to grow tax-deferred or tax-free. This means that as your money compounds, you won't have to pay taxes on the growth until you withdraw it, or in the case of a Roth IRA, not at all. Let's look at two scenarios. If you invest $5,000 annually in a taxable account with an average return of 7%, over 30 years you'll grow your investment to around $505,000, but you'll have to pay taxes on the gains. In contrast, if you invest in a Roth IRA, you'll still have the same growth, but you won't owe taxes when you withdraw the money. This allows you to keep more of your compounding gains. Maximizing tax-advantaged accounts can significantly accelerate your compounding strategy, especially for long-term retirement goals. Review your current retirement accounts. Are you contributing to tax-advantaged accounts like a 401k or IRA? If not, consider opening one and start contributing regularly to maximize the benefits of compounding without the drag of taxes. Chapter 6. The Dangers of Emotional Investing, Staying the Course. Investing is more than just a numbers game, it's also a test of emotional discipline. When markets fluctuate, it's easy to get caught up in the highs of a bull market or the panic of a downturn. Emotional investing can lead to poor decisions that undermine the power of compounding. In this chapter, we'll explore how emotional reactions to market swings can sabotage your wealth-building efforts, and how to develop the mindset to stay the course, letting compounding work for you in the long run. Emotional investing occurs when decisions are driven by fear, greed, or other emotions rather than rational analysis. It's human nature to feel excited when markets are rising and anxious when they fall, but acting on these emotions can have disastrous consequences for your financial future. One common example of emotional investing is panic selling during a market downturn. When markets fall, fear takes over, and many investors sell their assets to avoid further losses. However, this often results in locking in losses instead of riding out the downturn and allowing the market to recover. Historically, markets have always rebounded over time, and selling during a low point means missing out on future gains. On the flip side, overconfidence during a market upswing can lead to impulsive buying. Investors might chase high-performing stocks or get swept up in trends without considering the long-term value of their investments. This often leads to buying at inflated prices, only to experience losses when the market corrects itself. The key to avoiding emotional investing is to stay focused on your long-term goals and trust in the power of compounding. By staying consistent and not making rash decisions based on short-term market movements, you'll set yourself up for long-term success. Reflect on a time when you made a financial decision based on emotion. How did it impact your overall financial progress? Write down one strategy you'll use in the future to avoid emotional investing, such as consulting your long-term goals before making any major changes to your portfolio. Let's dive deeper into the cost of panic selling and why staying invested during market downturns is critical. Historically, the stock market has experienced regular corrections, drops of 10% or more, but it has also rebounded and continued to grow over time. Those who sell during a downturn often miss out on the recovery. Consider the 2008 financial crisis. During the crash, the market lost nearly 50% of its value, and many investors panicked, selling their assets to avoid further losses. However, the market rebounded over the following years, and those who stayed invested not only recovered their losses but saw their portfolios grow significantly. In contrast, those who sold during the downturn locked in their losses and missed out on the rebound. If you had invested $10,000 in the S&P 500 at the beginning of 2009, just after the crash, it would have grown to over $45,000 by 2021. This is the power of staying the course. The lesson here is clear: panic selling locks in losses. If you let fear dictate your actions, you undermine the compounding process, and your long-term goals are jeopardized. Trust in the market's resilience and stay committed to your investment strategy. What emotions are most likely to influence your financial decisions? Fear during downturns or excitement during market booms? Write down a reminder to consult your long-term plan during times of market volatility and avoid knee-jerk reactions. How to develop emotional discipline in investing. Developing emotional discipline is crucial to becoming a successful investor. While it's natural to feel fear or excitement when the market fluctuates, it's important to train yourself not to act on those emotions. Here are a few strategies to help you stay calm and focused on the long-term benefits of compounding. 1. Set clear financial goals. When you know what you're working toward, whether it's retirement, a home, or education savings, it's easier to stay focused on the long term. Write down your financial goals and review them regularly to keep yourself on track. 2. Have a plan. A well-thought-out investment plan can act as your guide during times of market volatility. If you have a strategy in place, such as regularly contributing to your portfolio regardless of market conditions, it's easier to stick to the plan and avoid emotional decisions. 3. Remember historical trends. Markets rise and fall, but over the long term they tend to go up. Remind yourself that market downturns are temporary, and staying invested gives you the opportunity to benefit from future growth. 4. Avoid checking your investments daily. Constantly monitoring the market can lead to overreactions. Instead, check your portfolio on a set schedule, such as monthly or quarterly, to avoid the temptation to act impulsively. 5. Automate your investments. By automating your contributions, you remove the temptation to make emotional decisions about when to invest. This helps you stay consistent and lets compounding work its magic over time. Choose one of the strategies above and implement it immediately. For example, if you haven't already, set a reminder to review your financial goals once a month, or automate your investments to remove emotion from the equation. Diversification isn't just about balancing risk, it's also about reducing the emotional impact of market fluctuations. When your portfolio is spread across different asset classes, stocks, bonds, real estate, you're less likely to experience severe losses when one area of the market underperforms. For example, if you only invest in tech stocks, a downturn in the tech industry could lead to significant losses, which may cause panic. However, if your portfolio includes a mix of stocks from various industries, as well as bonds or real estate, the impact of a downturn in one sector is less severe. This can help you stay calm and avoid emotional decisions. A diversified portfolio smooths out the ride, making it easier to stay the course during market volatility. By balancing high-growth assets like stocks with more stable investments like bonds, you allow compounding to work across multiple areas, reducing the risk of emotional decision-making. Take a look at your current investments. Are you diversified enough to weather market fluctuations, or are you overly concentrated in one area? Write down a plan to diversify your portfolio if necessary, reducing the emotional impact of market swings. The most important lesson in this chapter is to trust the process of compounding. When emotions run high during market volatility, it's easy to forget the long-term benefits of staying invested. But as you've learned, compounding rewards those who are patient and consistent. Think of your investments like a tree. It may sway in the wind during a storm, but its roots are strong, and over time, it continues to grow taller and more robust. Your portfolio will experience ups and downs, but if you stay the course, your money will continue to grow, often at an exponential rate over time. Staying the course means resisting the urge to sell during downturns and avoiding the temptation to chase high returns during market booms. It means committing to your investment plan and letting compounding work in your favor. Remember, compounding is a long-term game, and the biggest gains often come to those who wait. Emotional investing can sabotage your financial progress, but with the right mindset and strategies, you can stay the course and let compounding work for you. Focus on your long-term goals, diversify your investments, and trust that consistency will pay off in the end. Chapter 7. How to start with little and build big. One of the most common misconceptions about investing is that you need a lot of money to get started. In reality, the power of compounding is available to anyone, even if you're starting with a small amount. The key is not how much you begin with, but that you start now and stay consistent. In this chapter, we'll explore how even the smallest contributions can grow into significant wealth over time, and why the sooner you start, the greater your financial gains will be. Many people delay investing because they think their initial contribution won't be enough to make a difference. But even if you're starting with a small amount, $50, $100, or $200 per month, the power of compounding can still help you build substantial wealth over time. Let's break it down. If you invest $100 a month at an average return of 7%, you'll have just over $12,000 after 10 years. That may not seem like much, but if you keep investing the same amount for another 20 years, that $100 a month will have grown to over $81,000. And if you keep going for 30 years, you'll have nearly $245,000. The most important factor in building wealth isn't the amount you start with, it's how long you allow your money to compound. The earlier you start, even with small contributions, the more time compounding has to work its magic. If you haven't started investing yet, begin with a small amount you can comfortably contribute each month. Write down a specific amount, even if it's just $50, and set up automatic contributions to an investment account. A common barrier to investing is the belief that you need to wait until you have more money. Many people think, I'll start investing when I have a higher income, or I'll wait until I can contribute more each month. But waiting is one of the biggest mistakes you can make when it comes to compounding. The truth is, compounding doesn't care how much you start with, it only cares that you start. Every year you wait is a year of missed growth, and the longer you delay, the more you'll need to invest later to catch up. For example, if you start investing $100 a month at age 25, you'll have much more by retirement than if you wait until age 35 to begin, even if you contribute a higher amount later. The power of compounding is in the time you allow it to grow. If you keep waiting for the perfect moment or a higher income, you'll miss out on the exponential growth that could have been working for you in the meantime. The best time to start is now. Are you holding back from investing because you feel like you don't have enough to start? Write down one mindset shift you can make to prioritize starting now, even with a small amount. If you're starting with a small amount, it's important to be mindful of the costs associated with investing. High fees and expenses can eat away at your returns, especially when you're working with a smaller base of capital. That's why many beginner investors choose low-cost index funds or ETFs, exchange-traded funds, which offer diversification and growth potential without the high fees associated with actively managed funds. Index funds track a market index, such as the S&P 500, and have low management fees because they don't require active stock picking. This makes them a great option for small investors who want to benefit from market growth while keeping costs low. For example, let's say you invest in an index fund with a 0.10% expense ratio, compared to an actively managed mutual fund with a 1% expense ratio. Over 30 years, that seemingly small difference in fees can result in thousands of dollars more in your account. When starting small, minimizing costs is one of the best ways to maximize the impact of your contributions. Research low-cost index funds or ETFs, and compare their fees with other investment options. Choose one that aligns with your financial goals and has low expenses, then set up regular contributions. One of the simplest ways to ensure that your small contributions grow over time is to automate your investments. When you set up automatic transfers from your checking account to your investment account, you're ensuring that you consistently invest, even when life gets busy. Automation also eliminates the temptation to skip a month or two when things feel tight financially. Automating your contributions turns your financial growth into a habit, one that builds wealth without requiring constant attention. Over time, those automatic contributions, no matter how small, add up and allow compounding to work consistently in your favor. Automating your investments also helps with dollar cost averaging, a strategy where you invest the same amount of money at regular intervals, regardless of market conditions. By doing this, you're buying more shares when prices are low and fewer when prices are high, which averages out your cost and reduces the impact of market volatility over time. If you haven't already, automate your investment contributions. Choose a frequency that works for you monthly or bi-weekly, and ensure the amount is small enough to be manageable but consistent enough to grow over time. Harnessing the power of micro-investing platforms. If you're truly starting with very little, micro-investing platforms can be a great way to build wealth. These platforms allow you to invest small amounts of money, sometimes just the spare change from your everyday purchases. Over time, these small investments add up and start compounding, turning your spare change into real wealth. Micro-investing apps like Acorns, Stash, or Robinhood are designed to make investing accessible to everyone, regardless of income or experience level. They often round up your purchases to the nearest dollar and invest the difference in a diversified portfolio, giving you exposure to the stock market without needing to contribute large sums up front. While micro-investing might seem slow at first, it's a great way to dip your toes into the world of investing and build the habit of putting your money to work. As your income grows, you can increase your contributions, but micro-investing ensures that even the smallest amounts start compounding early. If you're starting with very little, explore micro-investing platforms and choose one that fits your needs. Set up an account and link it to your bank account so that every time you make a purchase, you're also investing in your future. The power of incremental increases. As you begin to invest, even with small amounts, it's important to look for opportunities to increase your contributions over time. One of the most powerful strategies for building wealth is to start small, then incrementally increase your contributions as your income grows or you free up more money. For example, if you start by investing $50 a month, try to increase that by 10% each year. Next year, you'll invest $55 a month. The year after, $60.50. These incremental increases might seem small, but over time they have a significant impact on the growth of your portfolio. This strategy also works for salary increases. Each time you receive a raise, increase your investment contributions by a percentage of that raise. By making these small adjustments, you're accelerating your wealth building without feeling the strain of investing large amounts all at once. Consider how you can gradually increase your contributions over time. Write down a plan to increase your monthly or yearly investment contributions as your financial situation improves. The key takeaway from this chapter is that it's not about how much you can invest right now, it's about getting started. The power of compounding doesn't require a large initial contribution, it requires time, consistency, and a commitment to letting your money grow. Even if you're only able to contribute a small amount each month, starting today gives you a head start on the compounding process. Over time, as your income grows or your financial situation improves, you can increase your contributions and watch your wealth accelerate. But the most important step is to begin. Remember, small steps can lead to big gains. The earlier you start, the more time compounding has to work its magic. It doesn't matter how much you have to invest today, what matters is that you start now. Small contributions, made consistently over time, will grow into significant wealth. Don't wait for the right moment or a bigger paycheck. Let time and compounding do the heavy lifting for you. Chapter 8. Automating your financial success, set it and forget it. One of the most powerful strategies for building wealth is to make the process automatic. Automating your finances allows you to save, invest, and grow your money without having to think about it constantly. By taking human emotion and decision-making out of the equation, you ensure that your financial plan stays on track. In this chapter, we'll explore how automation simplifies the wealth-building process, ensures consistency, and allows you to focus on other areas of your life while your money works for you. At its core, automation removes the need to make frequent decisions about when and how much to invest. Instead, you set up your savings and investments to happen on a regular schedule, whether weekly, bi-weekly, or monthly, without any further input from you. Why is this so powerful? Because the hardest part of saving and investing isn't the act itself, it's maintaining the discipline to do it consistently. Life gets busy, unexpected expenses arise, and it's easy to deprioritize your financial goals. Automation eliminates this inconsistency by turning saving and investing into habits that happen behind the scenes, regardless of what's going on in your life. Think of it as putting your wealth building on autopilot. By automating your contributions, you ensure that your financial plan remains consistent and your money continues to grow without the need for constant attention. Set up automatic transfers from your checking account to your savings or investment account. Choose an amount that feels manageable and a schedule that fits your pay cycle, whether it's weekly, bi-weekly, or monthly. Powerful benefit of automation. One of the key benefits of automating your investments is that it enables dollar-cost averaging, a strategy that reduces the impact of market volatility by investing a fixed amount of money at regular intervals. Instead of trying to time the market, buying low and selling high dollar-cost averaging ensures that you buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out the cost of your investments and helps smooth out the ups and downs of the market. Here's how it works. Let's say you invest $200 each month in a stock or index fund. When the market is down, the price of that stock or fund is lower, so your $200 buys more shares. When the market is up, your $200 buys fewer shares, but your previous investments have appreciated in value. Over time, this strategy helps mitigate the risk of investing during market peaks and ensures that you're consistently building wealth. The beauty of dollar-cost averaging is that it works best when you automate it. By setting up recurring contributions, you allow the market to do the work for you, reducing the need to track prices or worry about timing your investments. If you haven't already, automate your investment contributions and take advantage of dollar-cost averaging. Choose a fixed amount to invest regularly and allow the strategy to help you navigate market fluctuations over time. Automating savings for financial security. Automation isn't just for investments, it's also a powerful tool for building your savings, especially your emergency fund. Life is full of surprises, and having an emergency fund to cover unexpected expenses, such as car repairs, medical bills, or sudden job loss, ensures that you don't have to rely on credit or dip into your investments when things go wrong. Setting up an automatic transfer from your checking account to a separate savings account dedicated to emergencies ensures that your fund continues to grow without you having to think about it. This way, you're prepared for the unexpected, and you can rest easy knowing that your financial security is being taken care of in the background. How much should you save? A common goal is to have 3 to 6 months' worth of living expenses in your emergency fund. Automating this process helps you build that safety net steadily over time, without needing to adjust your budget every month. Set up an automatic transfer to your emergency fund. Start with a manageable amount, such as $50 or $100 per month, and let it grow over time. Make sure this account is separate from your regular checking account to avoid the temptation to spend it on non-emergencies. Automation doesn't just help with savings and investments, it's also a powerful tool for eliminating debt. If you're carrying high-interest debt, such as credit card balances or personal loans, automating your payments ensures that you're consistently paying down your balances and reducing interest over time. The key to eliminating debt with automation is to set up recurring payments that exceed the minimum payment required. By automating a fixed, slightly higher payment each month, you accelerate the repayment process, reduce the total interest paid, and free up more of your income for investing and saving. For example, if you have a credit card balance of $5,000 at 18% interest, making only the minimum payment will keep you in debt for years and cost you thousands in interest. But by automating larger payments, such as $200 or $300 a month, you can pay off the debt much faster and save a significant amount of money in interest. Review your debts and set up automated payments for each. Choose an amount higher than the minimum required, and allow automation to help you eliminate debt faster, while saving on interest. The psychological benefits of automation. Automation doesn't just have financial benefits, it also offers powerful psychological advantages. By automating your finances, you remove the stress and decision fatigue that come with managing money on a day-to-day basis. Instead of constantly thinking about saving, investing, or paying off debt, automation allows you to focus on other areas of your life while your financial plan works in the background. One of the biggest obstacles to financial success is the temptation to spend money impulsively or to delay saving for later. Automation removes this temptation by making the decision for you. Once your savings or investments are automated, that money is already allocated before you have the chance to spend it. This creates a sense of financial security and peace of mind. You know that your money is being managed, your goals are being met, and you're steadily building wealth without having to constantly monitor your accounts. In short, automation frees you from the mental burden of managing every aspect of your finances and gives you the confidence that you're on the right track. How often do you feel stressed about your finances? Consider how automation could relieve that stress by simplifying your financial life. Write down one area of your finances, savings, investing, or debt repayment that you could automate to create more peace of mind. Set it and forget it, but don't ignore it forever. While automation is a powerful tool for simplifying your finances, it's important to remember that set it and forget it doesn't mean you should ignore your financial plan entirely. Periodic check-ins are still essential to ensure that your investments and savings are aligned with your goals, and that your financial situation is evolving in the right direction. A good rule of thumb is to review your financial plan at least once or twice a year. During these check-ins, you can evaluate whether you need to adjust your contributions, reallocate your investments, or increase your savings to reflect changes in your income or lifestyle. The goal of automation is to take the day-to-day burden of managing your finances off your shoulders, but it doesn't mean abandoning your financial goals altogether. By automating the process and checking in periodically, you create a system that grows your wealth while giving you the flexibility to make adjustments when needed. Schedule a financial check-in every 6 months. During this time, review your investments, savings, and debt payments to ensure that everything is on track. Make any necessary adjustments to your contributions or financial plan to reflect changes in your income or goals. The long-term impact of automation is financial freedom. By consistently saving, investing, and eliminating debt through automated processes, you're building a strong financial foundation that will serve you for the rest of your life. The small, automatic steps you take today will compound over time, leading to significant financial gains in the future. Think of automation as a quiet, behind-the-scenes force that's working for you, even when you're not thinking about it. Every month your savings grow, your debt shrinks, and your investments compound, all without needing your constant attention. Over time, this automated system leads to financial security, wealth, and peace of mind. The true power of automation is that it aligns your financial habits with your long-term goals, ensuring that you stay on track without the need for constant effort or decision-making. By automating your finances today, you're setting yourself up for a future where your money works for you, not the other way around. Automation is your best tool for building wealth with minimal effort. By setting up automatic contributions to your savings, investments, and debt payments, you're creating a system that grows your financial security in the background. Set it, forget it, and let compounding do the rest. Chapter 9. Beyond Money. Applying compounding to habits and life. Compounding doesn't just apply to wealth building, it's a powerful principle that can impact almost every area of your life. Whether it's your health, career, relationships, or personal development, small, consistent actions taken over time can lead to extraordinary results. In this chapter, we'll explore how the concept of compounding applies to your daily habits and long-term goals, and how you can harness this power to transform not only your financial life but your entire life. The idea behind compounding in personal finance is that small contributions, made consistently over time, grow into significant wealth. The same principle applies to habits. Tiny actions, repeated consistently, can lead to life-changing outcomes. If you commit to walking for just 10 minutes a day, it might seem insignificant at first. But over the course of a year, those 10 minutes add up to over 60 hours of walking. If you keep this habit up for several years, the cumulative effect on your health will be profound. Similarly, saving just 10% of your income each month may not feel impactful at first, but over time, it builds into a substantial nest egg. The key to harnessing the power of compounding in your habits is to start small and be consistent. You don't need to make dramatic changes all at once, you just need to commit to taking small steps every day. Over time, these actions will build momentum, and you'll see exponential improvements in all areas of your life. Identify one area of your life where you'd like to make an improvement, whether it's health, personal development, or productivity. Write down one small, actionable habit that you can start today and commit to doing consistently over the next month. The compounding effect in personal development. Personal growth is one of the most powerful areas where compounding can have a profound impact. Just like investments, your knowledge, skills, and abilities grow exponentially when you dedicate time to learning and self-improvement consistently. Reading 10 pages of a book every day, spending 15 minutes a day learning a new skill, or dedicating time each week to personal reflection are small investments in yourself that, over time, lead to massive personal growth. Let's take the example of reading. If you read just 10 pages a day, you'll have read 3,650 pages in a year. That's about 15 books. Now, imagine what would happen if you committed to this habit for 5 years. You'd have read 75 books, gaining knowledge, insights, and perspectives that could transform your thinking, career, and life. The key is to stay consistent, even when it feels like the progress is slow. Personal growth compounds, and the biggest rewards often come after years of consistent effort. The longer you stick with it, the more profound the results will be. What's one area of personal development you've been neglecting? Write down one small step you can take today to start investing in your personal growth. Whether it's reading, learning a new skill, or dedicating time to reflection, commit to doing it consistently. Compounding doesn't just apply to personal growth or financial investments, it's also a powerful force in relationships. Small, consistent acts of kindness, communication, and attention can dramatically strengthen your relationships over time, whether with a partner, friends, or family. Imagine if you committed to spending just 15 minutes a day in undistracted conversation with your partner or family member. It might not seem like much, but over a year, that adds up to more than 90 hours of quality time. Over time, this builds trust, deepens connections, and improves the overall quality of the relationship. On the other hand, neglecting small, everyday interactions can have a compounding negative effect. Just as positive actions build on each other, so do negative habits. Small acts of neglect or unkindness can erode relationships over time. The compounding effect works both ways, so it's important to be mindful of how your actions today impact your relationships in the long run. Choose one relationship in your life that you want to improve. Write down one small action you can take consistently, whether it's sending a kind message, making time for a conversation, or offering support. Commit to doing it regularly and track the changes over time. Your career is another area where compounding can have a massive impact. Small efforts made consistently in your professional life, such as improving your skills, networking, or taking on new challenges, can lead to exponential career growth over time. The key is to focus on incremental improvements rather than waiting for a sudden breakthrough. For example, if you dedicate just 30 minutes a day to learning a new skill related to your field, that's 180 hours of learning over the course of a year. Those small efforts accumulate, making you more knowledgeable, competent, and marketable in your industry. The same applies to networking. Building relationships one conversation at a time can lead to unexpected opportunities down the road. The compounding effect in your career isn't always immediately visible, but over time, the small steps you take consistently will build momentum, creating bigger opportunities and advancing your professional life in ways you may not expect. Think about where you want to be in your career in the next 5 years. What small, consistent actions can you take now to move closer to that goal? Write down one skill, connection, or habit that you can invest in consistently. Just as positive habits compound over time, so do negative ones. Bad habits, whether in your finances, health, relationships, or personal life, build on themselves, creating bigger problems down the road. The small, unhealthy choices you make today can snowball into larger issues in the future. For example, consistently overspending by even a small amount each month can lead to significant debt over time. Procrastinating on important tasks can build stress and result in missed opportunities. Neglecting your health or relationships compounds in the same way, leading to problems that could have been avoided with small, positive actions. The compounding effect works both ways, which is why it's so important to identify and address negative habits early. By making small, positive changes today, you can prevent the negative consequences of compounding bad habits and instead shift the momentum in your favor. Identify one negative habit in your life that is compounding over time. Write down one small action you can take today to begin replacing that habit with a positive one, and commit to staying consistent. Building a compounding mindset for life. The power of compounding isn't just a financial strategy, it's a mindset. When you understand that small, consistent actions lead to significant long-term results, you begin to approach every area of your life differently. Instead of focusing on quick wins or immediate gratification, you start to prioritize habits, behaviors, and decisions that build momentum over time. Developing a compounding mindset means playing the long game. It means understanding that the most meaningful changes often happen slowly, and that the real rewards come from being patient, persistent, and consistent. Whether you're working on your finances, personal growth, relationships, or career, a compounding mindset allows you to build something sustainable and transformative over time. Compounding is a powerful force that extends beyond money. By applying the principle of compounding to your habits, relationships, career, and personal growth, you can create exponential improvements in every area of your life. Remember, small, consistent actions lead to big, transformative results if you stay patient and keep building. Chapter 10. Taking Action. Your 30-day plan to start compounding today. You've learned about the immense power of compounding and how it can transform not just your finances, but many areas of your life. Now, it's time to take action. This chapter will provide you with a step-by-step, 30-day plan to start applying the principles of compounding in your financial life and beyond. Whether you're starting with small investments, focusing on personal habits, or improving relationships, this action plan will help you build momentum and make lasting changes that compound over time. One of the most important lessons from this book is that the sooner you start, the greater your results will be. Compounding rewards those who begin early and remain consistent. No matter where you are today, it's crucial to take immediate action. Even the smallest step in the right direction will set you on a path towards significant growth. It's easy to get stuck in planning mode, waiting for the perfect moment to start, or feeling overwhelmed by the number of things you could do. But remember, the key to compounding is starting now, no matter how small the initial steps. This chapter provides a 30-day roadmap to get you moving in the right direction and build habits that will support your long-term goals. No matter how busy or uncertain life feels, remember that even small, immediate actions can have a big impact over time. Week 1. Set your financial foundation. During the first week of this 30-day plan, the focus will be on laying a solid financial foundation. You'll establish automatic contributions to your savings or investment accounts and begin building an emergency fund if you don't have one. 1. Day 1 to 2. Set up an emergency fund. If you don't already have one, set up a separate savings account dedicated to emergencies. Aim to save at least 3 to 6 months' worth of living expenses over time, but start small if needed. Automate monthly contributions to this account. 2. Day 3 to 4. Automate your investments. Choose a manageable amount to invest and automate contributions to a low-cost index fund or other investment account. Even if you can only start with a small monthly contribution, automation ensures consistency and removes the temptation to skip a month. 3. Day 5 to 7. Track your expenses and create a budget. Take a few days to track your current spending habits and create a simple budget. Identify areas where you can reduce spending and redirect those savings into your emergency fund or investment account. At the end of week 1, reflect on how it feels to have your finances automated. What challenges did you face when setting up your emergency fund or investments? How did creating a budget shift your mindset? Week 2. Build positive habits. Now that you've set the foundation for your financial future, it's time to focus on applying compounding to your personal life. Week 2 will be about building small, consistent habits that improve your health, productivity, or personal growth. 1. Day 8 to 10. Choose one personal development habit. Identify one area of personal development where you want to grow, whether it's reading, learning a new skill, or dedicating time to reflection. Start with a small, manageable goal, such as reading 10 pages a day or spending 15 minutes a day learning something new. 2. Day 11 to 14. Focus on your health. Pick one simple health habit to focus on for the rest of the month. It could be walking 15 minutes a day, drinking more water, or cutting back on processed foods. Small, consistent changes in your health will compound into long-term benefits. How do you feel after the first 2 weeks of small but consistent action? Write down any positive changes you've noticed in your mindset, energy levels, or productivity. Are you more motivated to keep building these habits? In week 3, you'll focus on making small, consistent efforts to improve and deepen your connections with others. This week's plan will include daily actions you can take to strengthen a key relationship in your life. 1. Day 15 to 17. Reach out and reconnect. Identify a relationship you want to improve, whether with a partner, friend, or family member. Spend 15 minutes each day in a focused, undistracted conversation with this person. If distance is a factor, send a thoughtful message or set up a virtual call. 2. Day 18 to 21. Show appreciation. For the next 4 days, practice expressing appreciation. Each day, send a message or take an action to show gratitude to someone important in your life. Small acts of kindness compound into stronger, deeper relationships. Reflect on the changes you've noticed in your relationships over the past week. How did small actions like reaching out or expressing appreciation impact your connection with others? Week 4. Accelerate your momentum. In the final week, you'll focus on amplifying your efforts. You'll revisit what you've learned and built over the past 3 weeks, and look for ways to increase your contributions, whether in your finances, habits, or relationships. By now, you've built a foundation of consistent action, and this week is about scaling those actions. 1. Day 22 to 24. Increase your investment contributions. Review your budget and see if you can increase your monthly contributions to your investment or savings account. Even a small increase of $10 or $20 a month will have a significant impact over time. 2. Day 25 to 27. Add another personal development goal. Add one more habit to your daily routine. It could be an extension of your existing habit, reading more pages, learning for a longer period, or it could be a new habit that builds on your progress. 3. Day 28 to 30. Strengthen another relationship. Choose another key relationship to focus on during the final 3 days. Reach out to this person, make time for a meaningful conversation, or express appreciation. Building strong relationships is a lifelong process, and small efforts compound over time. At the end of week 4, reflect on the progress you've made over the past month. How have your habits improved? What changes have you noticed in your finances or relationships? Write down one area where you'd like to continue compounding your efforts over the next 6 months. Building a long-term compounding plan. The 30-day plan is just the beginning. Now that you've built momentum, the key to long-term success is consistency. Continue to automate your finances, invest in personal development, and strengthen your relationships by making small, consistent efforts every day. Remember, compounding isn't a quick fix, it's a lifelong process that leads to exponential growth over time. To keep yourself on track, review your goals regularly and adjust your contributions, habits, or relationships as needed. Set reminders to check in on your financial and personal progress every 6 months and celebrate the small wins along the way. Commit to maintaining the habits you've built over the past 30 days. Set a reminder for 6 months from now to review your progress, increase your contributions, and continue building the compounding habits that will transform your life. The power of compounding lies in its simplicity. Small, consistent actions lead to massive, transformative results over time. Whether it's in your finances, personal development, or relationships, the key to success is staying the course and trusting the process. You don't need to make huge changes or dramatic leaps to achieve your goals, you just need to start now and keep going. Remember, every step you take today is a step toward a brighter future. By applying the principles of compounding to all areas of your life, you'll create lasting, meaningful change. Trust the process, stay patient, and watch as the small actions you take every day lead to extraordinary outcomes. The journey of compounding starts with a single step. Whether it's saving $50 a month, reading 10 pages a day, or making time for a loved one, every small action counts. Start today, stay consistent, and let the power of compounding work its magic in your life. Final words. You've come a long way in understanding the true power of compounding. What might have started as a simple concept has now revealed itself to be one of the most powerful forces for achieving financial freedom and personal growth. Remember, success doesn't come from grand gestures or overnight changes, it comes from small, consistent steps taken over time. Whether it's in your finances, relationships, or personal habits, the key is to start where you are and trust in the process. The journey ahead is yours to shape. Let compounding be the quiet but relentless engine that drives you toward your goals. Start today, stay patient, and watch your small actions lead to big, transformative results. The future is yours to grow. Let's make it remarkable. Take care and be well.